Hey guys, welcome back to the channel. If you haven't been here before, we talk about money and how to make it, how to save it, what to do with it, and everything in between. But today, we're going to be talking about market timing, or timing the market, right? So what is market timing, right? So market timing is the practice of trading in and out of a stock market or certain asset classes based on predictions of future price movements, right? So if you think a stock is going to do good or bad, like let's say you think a stock is going to go up a lot, so you would buy now at low while it's low. You think it's going to go up really high, say up 20%. You're going to sell it thinking it's going to go back down, right? You're going to lock in that profit, and then when it goes back down, maybe you buy it when it dips again and it goes back up another 20%, and then you sell it again, and that would be trading in and out, right? So followers of this strategy, they target that buying low and selling high, right, to try to time their trades in an effort to beat market returns. It's really hard to beat, say, like SPY or something like that, like a broad market index. A lot of people, they end up not doing as well. Actually, I think the statistics show most of the time, not only do they not beat index returns, generally they lose money, right? It's not something recommended, right? So let's say, for example, if the stock market suddenly climbs and hits new highs over a extended period, investors may believe a pullback is going to be happening really soon, and they might try to time their exit with the intention of avoiding, say, the market tumbling, right? So if a drop occurs, the next step would be to predict when it's going to bounce back, and you would try to get in and ride it back up, right? Just like the example we gave, right? So investors use different tools to try and predict these, future price movements. Some use technical analysis, or they might study like past market data, like price trends, trading volumes, and they use all these things to forecast future price action, right? Others use fundamental analysis, really going over a company's business prospects, their financial statements, to project or think or guesstimate how a stock is going to move over time. There are a lot of leading indicators that investors track to gauge sentiment and signal what lies ahead for the market, or what they think lies ahead, because nothing's guaranteed, right? No guarantee. You're guessing. It's an educated guess, right? So timing the market versus time in the market, right? Though investors might occasionally be able to make the right call, consistently placing the correct bet at the most opportune time it's impossible. Like, you're not good. Like, you might get lucky once or twice, but eventually you're gonna lose way more, right? There are real consequences, when market timing doesn't work out, right? It's like what we talked about earlier, right? If an investor gets out of the market too early, or a market drop never actually happens, you could lose out on crazy gains. Like, let's say, you put your money in, right, and it goes up 20%. Remember how we got to 20%? We thought it was going to go down, so we sold, and then it went down. What if it went up another 20% and you sold? And you just lost out on that other 20%, right? And if you were to buy in again, you would probably be buying it. You'd be buying in at a much higher price point, and your gains wouldn't be significantly reduced, but they would be much lower than they would have been, right? It's just an example, right? If in a 2020 report, though, see, from I'm trying to remember who it was. I think it was BlackRock. They showed that, like, a $100,000 investment in the S&P 500 from 2000 to 2019, the difference in investment returns when staying invested over the entire time frame versus missing, it was like a couple of the good days in the market. it was just night and day difference, right? You miss out on a lot of money. So you can see here, right, if you miss the 5 best days, right, your annual total return, right, is 6.85. You know, you might think to yourself, oh, like that's not that much. I'm like, yeah, it really is though. It really is. Right? But missing the 10 best days, you can see missing the 20 best days out of a situation, right? I mean, it cuts your profits in half, right? So it's better to stay in, right? You don't really want to try to time the market. You just want to have time in the market, right? So, staying invested, spending more time in the market rather than trying to time it is yielded better results over the long term, right? Even though investment returns would have fallen during downturns, staying the course allowed the investments to recover when the market rebounded, continuing to grow and compound. Compound interest is just the best, right? When trying to time the market, investors they need to constantly watch market movements and attempt to make those optimal trades, right? Besides being just incredibly time consuming, right? A more active trading strategy could mean higher trading costs and potentially additional tax consequences for your everyday investor, right? And for these reasons, along with likely reduced returns, most advisors are going to suggest and tell you, using a buy and hold strategy that focuses on time in the market rather than trying to time the market, right? Aside from not being able to time the market like 100% right, there can be other reasons investors miss out on good days in the market or end up not executing on a buy low, sell high, mentality, right? Over the course of a year, the stock market trades up and down, and it's common for investors to encounter various pullbacks. It might be a 2% dip, 3% dip, 5% dip, right, which typically can happen several times a year, or a more significant stock market correction characterized by, a 10%, 20% drop from a recent market high, right? So, using the buy low rule of thumb, investors can get their shop on, like you just go in there and get that shop on, right? I mean, just you see that dip, buy. That's why you've heard that rule before, right? Buy the dip, buy the dip, buy the dip, right? Because you want to keep your money in the long term. You don't want to take it out, but every time it dips, you want to put a little bit extra in, right? It dips, put a little bit extra in. Like you can see here, right? It goes up, it dips down, you put more money in, right? Goes up, goes down, put more money in. Goes up, goes down, put more money in, right? And it's that's why most people tell you to do it. It's the easiest way of increasing your returns and lowering your average cost point, right? But as the stock market falls, investors they often grow anxious watching, like if you're constantly watching your portfolio's value like go down and you're like, I'm gonna get out early, right? You're gonna miss that ride up, right? So this results in investors doing exactly the opposite of what you should be doing, right? So you end up instead of buying low, you're selling low, right? And once you're out of the market, a lot of investors wait on the sidelines until they feel comfortable getting back in, which is often after the market has already corrected and rebounded, which means you end up buying high, right? You let your emotions get the better of you, right? And why does this matter? Well, because once a stock is sold at a price lower than it was bought, a lot of investors are gonna, succumb to investment risk, locking in a permanent loss, right? And it's just you can't be watching it every day. It's really not the best, right? I actually think that most people should have have your portfolio automatically set up to say every paycheck or every Friday, or you set it, maybe every other week, once a month, automatically have money deposited into your portfolio and have it automatically buy. That's what I do, and I think that's the best way for people to not even look, right? Don't pay attention to it, right? But taming the temptation to time the markets, right? Like every investor wants the best possible return on their portfolio, and some might be tempted to time the market in pursuit of this goal. Weathering the ups and downs of the market can be really tough to stomach, especially during like volatile times. But there are ways investors can stay calm, cool, and invested, right? So you need to mind your asset allocation, right? Making sure your portfolio has an appropriate asset allocation is key to reducing your investment risk, right? Asset allocation means spreading your investable dollars across various asset classes or categories of investments, right? Stocks, bonds, cash, real estate, gold, right? Based upon your goals, your risk tolerance, and your time horizon, right? Which your time horizon is basically going to be the amount of time you have that you want to invest before you retire or until X date, right? Diversification, it takes this one step further, breaking those asset classes down into more subcategories, such as by market capitalization, which is the size of a company, their geographic location or style, right? Growth versus value oriented companies, right? And as the market moves, the best performing asset class this year might be the worst performing next year. Sometimes stocks will be up and bonds down, but other times it'll be the exact opposite, right? So by investing in different asset classes, investors typically gain protection against market volatility, and being well diversified can further reduce your risk, right? Because it's less likely that one investment is going to just drop your entire portfolio value, right? Understanding why you've safeguarded your portfolio with asset allocation and diversification, can't talk today, can help provide peace of mind, helping to quell emotional urges and that itch to time the market. Like, oh, I think I can do this. Like I said, it might work out once or twice, but eventually you're like, oh, I'm gonna put money in. You're gonna end up buying high. It's gonna end up dropping down real low, and then you're gonna be like, I've already lost this money. Let me sell. Then it's gonna go back up, and you're gonna be like, frick, right? So the next thing we're gonna talk about is what I was talking about earlier, right? You're gonna dollar cost average, right? So investors can also achieve better pricing when investing through strategies like dollar cost averaging or DCA, right? Which basically just means spreading your purchases out over time, right? Buying about the same amount over regular intervals, right? As the market moves, you'll buy more shares when the market is down and fewer when the market is up, which can smooth out your average purchase price over time, right? So like we can see here, if you at the start, if you were to put in a lump sum of $8,000, right, and ride it out as the market, goes from $10 to $14, down to $9, up, down, up, right? They ended up having a 0% gain. But if you do a monthly investment of $1,000, right, $1,000 at 10, $1,000 at 14, $1,000 at 9, at 13 and a half, 8, 8.5, 7.5, 10, you end up making a return of about a little over 4%, right? Because the average cost that you purchased was under that $10, right? Or close to it. Like for the entire sum, it's a little bit over, but like you end up purchasing like 9.61, right? So it's just setting up that automatic purchasing, right? Like I get paid every other Friday, right? So I have it set up to where I put X amount of dollars in my savings account, and then my savings account every Friday automatically sends I think it's $150 to my portfolio, and it automatically spreads my $150 out on my portfolio every Friday, just every single Friday, right? So the next thing and last thing we're going to be talking about is working with an advisor, right? So another option that you can have is to rely on the guidance of someone who knows what they're talking about and what they're doing. If you're too afraid to do it yourself, right? Financial advisors, they can help you make a plan for reaching your goal, right? Whatever you want to accomplish financially, right? They can recommend appropriate investments, and provide ongoing investment advice, right? You might be prone to feeling anxious about the markets, and having an advisor take the reins or basically hold your hand can really help you stay on course with your investments, right? Depending upon the level of service you want, you can choose an advisor who will fit your needs. Definitely shop around. Don't just Google, the closest advisor to you, right? Definitely see a couple people, see how you feel with them. Do they listen to you and stuff like that, right? But the biggest takeaways I can give to people is, if you don't feel safe doing a little bit of research yourself, get an advisor. If you feel comfortable with being able to do the research yourself, I would say putting your money in the market, dollar cost averaging in over the long term is going to be your best bet. And that could be and that doesn't have to be in individual stocks either. That could be in index funds, mutual funds, like whatever you've done your research into and you feel comfortable with. That's what you should be doing, right? So I really hope you guys stayed for the whole video. If you did stay, I really appreciate it. If you guys could go down and give this video a like, go ahead and subscribe. Leave a comment down below if there's something you want me to talk about or something you liked or didn't like. Let me know. I'm here to please, And hopefully I'll see you guys in the next video. And until then, y'all be safe.